The moment you stop gambling and start trading is not marked by excitement but by restraint. When price no longer tempts you to act, but informs you to wait, you've crossed the line. Example: the gambler buys every breakout. The trader studies cause, waits for absorption, enters only after strength is proven, risks little, and exits without hope. 5 signs reveal when speculation ends and professional judgment begins. The line that separates the gambler from the trader is not drawn by intelligence, capital, or ambition. It is drawn by attitude. The gambler approaches the market seeking excitement, validation, and quick reward. The trader approaches it as a student of cause and effect, knowing that profit is the byproduct of correct judgment, not of bold action. The gambler believes activity creates opportunity. He feels compelled to act, mistaking motion for meaning. A rising price excites him, a falling price frightens him. He buys because price is moving, sells because it stops, and justifies his decisions after the fact. His opinions are shaped by tips, news, indicators, and the behavior of others. In truth, he is not operating, he is reacting. The trader, by contrast, understands that the market does not reward speed, it rewards preparation. He knows that price movement is the result of professional campaigns conducted by informed interests. These operators do not chase price. They prepare positions quietly, test supply, absorb opposition, and advance only when conditions favor them. The trader's task is not to predict but to observe and align himself with these operations. Where the gambler asks, "How much can I make?" the trader asks, "Where is the risk?" This single question changes everything. The gambler places his capital in jeopardy first and seeks justification later. The trader defines risk before entry, limits it ruthlessly, and accepts losses as a cost of business. He does not average down in hope, nor does he hold winners in prayer. Hope and fear are the twin engines of gambling. Discipline and logic are the tools of trading. Consider a common example. Price breaks above a visible resistance level. The gambler, fearing he will miss the move, buys immediately, often at the point where professional demand is already satisfied. When price hesitates or reacts, he panics, sells at a loss, and vows to wait for confirmation next time. The trader, however, studies the background. He asks, was there prior accumulation? Was supply absorbed on reactions? Did the breakout occur with ease of movement? He waits for a constructive test, enters with limited risk, and remains indifferent to short-term fluctuation. The gambler measures success by being right. The trader measures success by executing correctly. He understands that even the best analysis can be wrong, but poor discipline is always fatal. He trades less, not more. He acts only when conditions are favorable, and he remains inactive when they are not, knowing that inactivity is often the most profitable position. The moment you stop gambling and start trading is the moment the market no longer controls your emotions. You no longer seek action. You seek alignment. You no longer trade because you can, but because the market has invited you. That moment marks the beginning of professionalism and the end of costly speculation. One of the most expensive errors committed by the untrained speculator is the belief that anticipation is superior to confirmation. He prides himself on buying the low tick and selling the high tick, mistaking good fortune for skill. In doing so, he aligns himself not with professional interests, but against them. The market does not reward those who guess correctly, it rewards those who wait correctly. The professional trader understands that strength must be proven. Price does not advance sustainably because it is cheap, oversold, or supported by opinion. It advances because demand has overcome supply, and that fact can be observed if one has the patience to look. Confirmation is not delay, it is evidence. And evidence is the trader's only legitimate authority. The gambler buys in the middle of weakness. He sees price falling, assumes value, and enters while supply is still dominant. When price continues lower, he calls it manipulation, bad luck, or stop hunting. The trader, on the other hand, knows that weakness must exhaust itself before strength can emerge. He waits for selling pressure to diminish, for spreads to narrow, for volume to show absorption rather than panic. He allows the market to demonstrate that supply has been met. Confirmation of strength appears in clear, repeatable forms, a rally that travels farther than previous rallies. A breakout from a trading range that occurs with ease of movement, a reaction that holds above prior support and occurs on diminished volume. These are not theories, they are facts recorded on the chart. They signal that professional demand is in control and that the path of least resistance has turned upward. Consider a typical accumulation range. The gambler attempts to buy every decline within the range, believing proximity to the low guarantees safety. He endures repeated drawdowns, emotional strain, and eventually liquidation, often just before the true advance begins. The trader waits. He allows the range to complete its work. He observes the sign of strength, a decisive rally, and then waits again for the last point of support. Only when price confirms its intention does he commit capital, and even then, with limited risk. Waiting for confirmation also protects the trader from false narratives. News, rumors, and opinions may suggest strength, but price and volume reveal whether those stories are being acted upon by informed interests. Professionals do not need headlines to move markets. They leave footprints. The trader's discipline is to follow those footprints, not the noise surrounding them. Patience is not passive. It is an active state of observation, analysis, and restraint. The trader is constantly asking, has the character of price changed? Has demand demonstrated dominance? Has the market done something it failed to do before? Until the answer is yes, he does nothing and loses nothing. The moment you begin waiting for confirmation of strength, you relinquish the illusion of control and gain something far more valuable: alignment with reality. You stop trying to be early and start trying to be right. And in the long run, it is not the earliest entry that pays, but the safest one, taken after the market itself has spoken. All price movement in the market may be reduced to a single governing principle: the balance between supply and demand. Every advance, every decline, every period of congestion is nothing more than a record of this struggle. The untrained participants see only price. The trained trader reads pressure. It is this ability rather than prediction that separates professional judgment from blind speculation. The gambler believes that indicators reveal the future. He overlays his charts with formulas, oscillators, and signals, hoping that complexity will substitute for understanding. Yet none of these tools create movement. They merely reinterpret what price has already done. The trader, by contrast, studies the raw evidence, how price behaves when confronted with opposition, and how much effort is required to produce a result. Supply reveals itself through widening spreads on declines, increased volume on downswings, and the inability of price to rally far from support. Demand reveals itself through narrowing spreads on reactions, expanding progress on rallies, and the ease with which price overcomes resistance. These signs are not subtle once understood. They are persistent and logical. Consider a market in apparent decline. The gambler sees falling prices and assumes further weakness. He sells late, often near the point where professional interests are absorbing supply. The trader watches more closely. He notes that despite heavy volume, price no longer makes significant downward progress. Rallies begin to travel farther. Reactions become shallower. This tells him that supply, while active, is being met by stronger hands. The decline has lost its authority. Effort versus result is the trader's compass. When great effort produces little result, the prevailing force is weakening. When modest effort produces outsized movement, control has shifted. A rally on light volume that advances easily may signify stronger demand than a labored advance on excessive activity. The gambler counts volume, the trader weighs it. In distribution, the same principle applies in reverse. The public sees rising prices and assumes strength. The trader observes that rallies require increasing effort, spreads narrow near the top, and reactions become sharper. Supply is entering quietly, using public demand as an exit. What appears healthy to the crowd is often exhaustion to the professional. Reading supply and demand also demands context. No signal exists in isolation. A wide-spread down bar may indicate weakness in a markup or absorption in an accumulation. Only the background reveals the truth. The trader studies where price is in the larger structure and asks whether current behavior confirms or contradicts that position. This discipline removes emotion from decision-making. The trader no longer fears declines or celebrates rallies. He reads them. He understands that markets fall to find demand and rise to find supply. His role is not to fight this process, but to recognize when one side has gained the advantage. The moment you begin reading supply and demand, the market ceases to be mysterious. Price becomes a language, not a threat. You stop trading opinions and start trading evidence. And once you learn to interpret that evidence correctly, you will discover that the market is always telling the truth long before the crowd is willing to listen. One of the least understood yet most fundamental laws governing market behavior is the law of cause and effect. The public is inclined to believe that price moves because of news, emotion, or sudden opportunity. In truth, price moves because it must. Every significant advance or decline is the result of prior preparation. The market does not leap, it unfolds. The gambler looks at a sharp advance and assumes opportunity has just appeared. He rushes in, believing he is witnessing the beginning, when in fact he is often participating in the end. He does not ask what has preceded the move, nor does he care how long preparation has been underway. He trades effects without knowledge of cause and pays for it repeatedly. The professional trader begins his analysis in the background. He understands that large interests cannot accumulate or distribute positions in a single session without betraying their intentions. They must operate over time, creating ranges where supply and demand may be exchanged quietly. These trading ranges are not periods in decision, they are periods of construction. The length, width, and character of these ranges determine the magnitude of the move that follows. Cause is built during accumulation or distribution. Effect is expressed during markup or markdown. The trader's advantage lies in recognizing the cause before the effect becomes obvious to the crowd. This does not mean predicting the future, it means measuring preparation. A small cause can only produce a small effect. A large cause, built patiently, produces a movement of corresponding scope. Consider an accumulation range. To the gambler, it appears dull, directionless, and unprofitable. He abandons it in search of excitement elsewhere. The trader studies it carefully. He notes how price reacts to selling pressure, how volume behaves at support, how rallies expand or contract. Each test, each spring, each absorption adds to the cause. When the market finally leaves the range with strength, the trader is prepared, not surprised. The law of cause and effect also governs risk. When the cause is small or poorly defined, the effect is uncertain. The trader avoids such situations. He prefers markets where preparation is clear, boundaries are visible, and risk can be measured. This is why professional trading appears slow and selective. It is anchored in logic rather than impulse. The gambler believes profit comes from being active. The trader knows profit comes from being aligned with structure. He waits for the market to complete its work. He does not chase moves that lack foundation, nor does he fear missing opportunities that were never properly prepared. There will always be another campaign, another cause forming somewhere. Once you understand cause and effect, the market's behavior becomes orderly. You stop asking, why did price move? And begin asking, what prepared this move? That single shift transforms randomness into reason. The moment you trade cause instead of effect, you step out of the crowd and into the company of professionals. You no longer participate in sudden moves. You participate in planned campaigns. And in the long run, it is not speed or brilliance that produces success, but patience in recognizing when the market has finished preparing and is ready to act. The desire for excitement is the silent enemy of profitable trading. It disguises itself as confidence, conviction, and boldness, yet its true function is to destroy capital. The market does not reward courage in the absence of judgment. It rewards restraint, calculation, and the constant preservation of trading capital. Those who seek thrill inevitably pay tuition. Those who control risk earn longevity. The gambler enters the market for stimulation. He measures opportunity by the size of the potential gain and ignores the size of the potential loss. Large positions, narrow stops, and impulsive entries provide emotional satisfaction even when they provide financial damage. He equates intensity with seriousness, believing that the more he risks, the more committed he is. In reality, he is merely exposed. The professional trader begins from the opposite premise. Capital is his inventory. Without it, opportunity ceases to exist. Every trade is evaluated first on risk, not reward. If risk cannot be clearly defined, the trade is dismissed regardless of how attractive the potential appears. This discipline alone removes the majority of losing situations from consideration. Risk control is not pessimism, it is precision. The trader identifies logical points of invalidation areas where the market proves his judgment wrong. He positions his stop where the premise of the trade no longer exists, not where discomfort begins. Losses taken in this manner are not failures. They are confirmations that the trader has respected the market's verdict. Excitement thrives in uncertainty. It encourages oversized positions, premature entries, and the refusal to exit. Risk control thrives in clarity. The trader waits for conditions where structure is defined, cause has been built, and confirmation has appeared. These conditions allow him to risk little in pursuit of much, a relationship that no gambler can maintain consistently. Consider two participants entering the same market. One risks 10% of his capital on a hunch, confident that he is right. The other risks 1% after confirmation, indifferent to outcome. A single adverse move can remove the first from the game entirely. The second can withstand a series of losses without emotional or financial impairment. Over time, survival becomes superiority. The trader also understands that controlling risk controls emotion. When exposure is limited, fear diminishes. When fear diminishes, judgment improves. When judgment improves, execution becomes consistent. This virtuous cycle is impossible for the gambler, whose oversized risk ensures constant emotional disturbance. Perhaps the most difficult form of risk. Control is doing nothing. The trader recognizes that many markets are unsuitable, lacking preparation, structure, or clarity. He resists the urge to manufacture opportunity where none exists. The gambler cannot. He must act, even when conditions are hostile. In doing so, he converts uncertainty into loss. The moment you choose risk control over excitement, trading ceases to be dramatic. There are fewer stories, fewer adrenaline spikes, and fewer emotional scars. In their place comes steadiness, patience, and compound growth. Professional trading is not thrilling, and that is precisely why it works. The market does not pay for excitement. It pays for discipline, and those who master risk first will discover that profit follows quietly, consistently, and without spectacle. The market is not a random collection of independent actions. It is a composite record of deliberate campaigns conducted by informed and well-capitalized interests. To trade successfully, one must abandon the notion of competing against these interests and instead learn to align with them. This principle lies at the heart of professional speculation. The untrained trader believes he is trading against other individuals much like himself. He imagines a fair contest of opinions, where intelligence and conviction alone determine outcome. In reality, he is reacting to movements engineered by operators whose objectives require time, patience, and deception. These interests do not reveal their intentions openly. They test the market, withdraw, probe for supply, and advance only when conditions permit. The public provides the necessary liquidity, often unknowingly. Wyckoff referred to this controlling force as the composite operator, not a single entity, but the combined actions of large interests whose behavior can be studied as if they were one mind. Their footprints are visible in price and volume, for they cannot operate without leaving evidence. The trader's task is to recognize this evidence and act in harmony with it, not to anticipate, argue, or interfere. The gambler fights the composite operator. He buys where professionals sell and sells where professionals buy. He chases strength that is already being distributed and abandons weakness that is being absorbed. When his positions fail, he blames manipulation, unaware that manipulation is simply professional operation observed too late. The trader studies behavior. He asks, is the market absorbing supply or rejecting it? Are reactions shallow or severe? Does price advance with ease or resistance? Each answer reveals intent. During accumulation, the composite operator allows price to decline or move sideways to test remaining supply. During distribution, he encourages optimism and participation while quietly liquidating positions. The trader does not take these moves personally. He recognizes them as preparation. Acting with the composite operator requires humility. The trader accepts that he will never know intentions with certainty. He does not need to. He waits for confirmation, signs of strength after accumulation, or signs of weakness after distribution. Only when the market confirms direction does he act, and even then with measured risk. This alignment also explains why professional traders appear inactive for long periods. They are waiting for campaigns to mature. They understand that premature entry aligns them with uncertainty, not strength. The gambler grows impatient during these periods and seeks action elsewhere, often becoming the liquidity that professionals require. To act with the composite operator is to trade in phase with the market. You advance when he advances and withdraw when he withdraws. You do not demand movement, you respond to it. This approach transforms trading from confrontation into cooperation. The moment you stop trying to outsmart the market and start studying its structure, you step into a position of advantage. You no longer trade headlines, indicators, or opinions. You trade intent as revealed through price and volume. In the end, the composite operator always wins, not because he is clever, but because he is prepared. The professional trader survives and prospers by recognizing this truth and placing himself quietly and patiently on the same side of the campaign. The transition from gambling to trading is not achieved through a new indicator, greater leverage, or sharper prediction. It is achieved through a fundamental change in conduct. The market does not reward opinion, excitement, or constant activity. It rewards judgment exercised with patience, discipline, and respect for cause and effect. When you abandon the gambler's urge to act and adopt the trader's habit of waiting, you begin to see the market as it truly is, a record of professional operations governed by supply and demand. You wait for strength to confirm itself. You measure preparation before expecting results. You control risk before pursuing profit. And above all, you align your actions with the composite operator rather than struggling against him. These principles are not modern innovations. They are timeless because human behavior is unchanged. The crowd still chases movement. The professional still prepares in silence. The difference between loss and profit lies in which side of that divide you choose to stand. The moment you stop gambling and start trading is the moment you surrender excitement for consistency, prediction for observation, and hope for evidence. From that moment forward, success is no longer a matter of chance, but of method.